right now, you are watching a market that is defined by absolute paradoxes. I mean, it is just wild out there today.
Yeah, wild is definitely the word for it. It's totally disconnected.
Exactly. Like, we have this massive geopolitical conflict driving up the price of global oil, right? But the crazy part is the giant energy producers who are pulling that oil out of the ground are somehow they're totally missing out on the windfall.
Which makes zero sense on the surface.
Right. And then, we have the whole artificial intelligence revolution, which is just absolutely terrifying investors in one sector, gutting these legacy companies.
Oh, completely gutting them.
Yeah, while at the exact same time, it's minting historic, record-breaking billionaires in another sector.
The wealth transfer is just staggering to watch.
It really is. And through all of this seemingly apocalyptic chaos, we have a legendary Wall Street veteran looking at the data and claiming that a massive historic market rally is actually just getting started.
Which is just a huge disconnect between the scary headlines you read and, the underlying mechanics of where capital is actually flowing right now.
Yeah, and that is exactly what we are here to decode. So welcome to the 24/7 NovaStream.
Glad to be here with you all.
If you've got our feed up right now, you are already seeing the live crypto market tracking on your screen. Those dynamic spark lines for BTC, ETH, and SOL have been incredibly volatile today.
Very volatile, yeah. The swings are huge.
And you're also seeing our real-time global financial indices keeping tabs on the S&P 500, the NASDAQ, Forex pairs, and commodities. And of course, our auto-curated breaking news feed is just scrolling by with the latest from the financial, political, and tech worlds the absolute second they break.
It never stops.
It doesn't. And our mission for this deep dive is to take today's stack of breaking sources and extract the vital insights so you know exactly what is driving these charts. Okay, let's unpack this.
We really have to start with the largest macroeconomic force dominating that breaking news feed today, which is the geopolitical shockwaves coming out of the Middle East.
Right. Specifically, we are looking at the U.S.-Iran standoff over the Strait of Hormuz and its immediate ripple effect on global commodities and actually crypto as well.
Yeah, it hit everything.
It did.
Okay.
But really quick, before we get into the data, I want to be explicitly clear to you listening. NovaStream takes absolutely no political side in the U.S.-Iran conflict.
Not at all.
Right. Our discussion today is strictly an impartial report on the financial data and the market impacts that are, contained within our source material. We're simply analyzing how the markets are reacting to the events on the ground.
And that is a really crucial distinction to make. We are entirely focused on the mechanics of the market response. And honestly, that response has been violent.
Extremely violent.
Yeah, Iran's swift closure of the Strait of Hormuz, which, came right after a very brief 24-hour opening over the weekend, it just immediately rattled global markets.
It's a total shockwave.
Exactly. It caused oil prices to spike, which sent volatility rippling across all asset classes. It even temporarily dragged on Bitcoin's rally, though BTC did manage to hit that $78,000 mark after rallying, 7% last week?
Yeah, 7%. But the really wild numbers, the ones that just defy basic logic, are in the energy sector itself. Brent crude climbed back above $101 a barrel.
Which is a huge psychological level.
Right. Now, common sense tells you that if you are in the business of selling oil and the price of oil skyrockets, you should be celebrating, popping champagne. And at first glance, the market kind of agrees. The S&P energy sector is up nearly 26% so far this year.
Yes, because traditional logic dictates that higher crude prices act as a direct tailwind for exploration and production companies. They sell their output at higher margins, revenues jump, and profits follow.
Seems simple enough.
Right. But as we dig into the corporate reporting today, that direct translation from high oil price to high corporate profit is just completely breaking down.
It's totally broken. Because actually pulling oil out of a conflict zone is wildly expensive. The U.S.-Iran standoff is pushing up the cost of the commodity. Yeah, but operating in that environment is just eating the profits alive.
Oh, the overhead is astronomical right now.
You have soaring insurance premiums for tankers, you've got massive security spending, and these crippling supply chain disruptions. Take Halliburton, for example, the major oil services firm.
Yeah, their numbers were shocking.
They just reported a 13% drop in their Middle East and Asia revenues specifically because of this conflict.
Well, the closure of the Strait of Hormuz fundamentally changes the operational paradigm. We've had relatively open shipping seaways there for decades. When you suddenly close that off or even just threaten it,
The cost of doing business just absolutely skyrockets.
Exactly. Tankers have to reroute, Insurers demand massive premiums for war risk coverage, and companies have to scramble to diversify their supply sources. That requires massive upfront capital just to maintain the status quo.
Right, but the crazy thing is, those operational costs aren't even the biggest drain on these companies right now. It's their financial hedging. This part absolutely blew my mind.
Yeah, this is the really structural issue.
So, coming into the year, before this conflict even erupted, the International Energy Agency estimated a massive global supply glut, like a record annual surplus of nearly 4 million barrels a day.
They thought we were going to be swimming in oil.
Right. So oil companies looked at that projection, and they decided to lock in their selling prices around $60 a barrel, basically to protect themselves from a price collapse.
It was supposed to be the safe play.
Exactly. But then the conflict starts, and Brent crude peaks at $118.35 in late March. Here's where it gets really interesting. It's like a farmer pre-selling their entire autumn harvest at a massive discount because they expected a surplus. Right.
Oh, that's a perfect way to look at it.
Yeah, only to watch a sudden, devastating drought make crop prices skyrocket in the summer. They're surrounded by incredibly valuable goods, but they legally signed a contract to sell it all for pennies.
What's fascinating here is how the mechanics of financial derivatives can actually decouple a company from the physical reality of the commodity they produce.
It really is. So how so? Like, walk us through how a company actually gets trapped like that.
Well, large producers use futures contracts and options to guarantee a baseline revenue. Like I said, it is usually considered prudent risk management.
Right, you want predictable revenue.
Exactly. You promise to deliver 1 million barrels of oil in 6 months at $60 a barrel. You get your revenue certainty. But when you lock in at 60 and the physical spot price doubles to 118, you miss the entire upside.
Ouch.
Yeah, you suffer multi-billion-dollar paper losses on those financial hedges, which essentially cancel out the benefit of the higher physical oil prices.
So they are literally handcuffed to the old price.
Exactly, handcuffed. Now, those contracts do roll off eventually. ExxonMobil, for instance, expects higher profitability in later quarters as those derivative contracts expire, and they can finally sell at current market rates.
Assuming the price stays high.
Right, and that's the painful part, because we might have already seen the peak. Brent is already down 14.4% from that late March high, and analysts at Societe Generale expect it to settle back around $85 before the end of the year.
So the oil companies might just miss the window entirely.
Very likely.
Okay, so if the companies producing the oil are boxed in by these paper contracts and missing the windfall, what happens to the companies that physically have to burn that expensive fuel?
Now we're talking about the airlines.
Yes, which brings us to American Airlines, who just reported their first quarter results. And I have to say, looking at these numbers, they feel totally disconnected from the reality of $100 a barrel oil.
This is exactly where we see how macroeconomic shocks filter down into the consumer economy.
Right. So American Airlines reported a record first quarter revenue of $13.91 billion.
Record revenue.
A record. That is a 10.8% increase from a year ago. Their stock actually rose 1.3% in pre-market trading on this news, and their per-share loss narrowed to 40 cents, beating Wall Street expectations.
And people are flying more, too.
Yeah. Passenger traffic is up 3.9%. So all of this sounds amazing until you actually look at their fuel bill.
Right. The fuel bill is the massive elephant in the room for literally any logistics or transportation company right now.
Because their average fuel price jumped 10.7% to $2.75 a gallon. And it gets worse. Their forward outlook assumes a sharp increase to $4 a gallon because of the ongoing Iran conflict.
Which is a massive jump.
It translates to a projected $4 billion increase in expenses for the airline. So I'm looking at these two data points, and I am just scratching my head. Wait, if your core operational cost is spiking by $4 billion, how are you hitting record revenues and seeing your stock go up? The math feels broken.
The math only works if you have an external shock absorber. And right now, that shock absorber is you, the consumer. Yeah, American Airlines is explicitly pointing to incredibly strong travel demand, specifically premium travel demand, to offset these costs. They are using that demand to what they call, quote, recapture elevated fuel prices.
Wait, recapture, let's translate that corporate speak. They just mean they are raising ticket prices, right?
Precisely. They are taking that $4 billion geopolitical tax and passing it directly onto the traveler. And the vital metric here is that the traveler is actually paying it.
They're just absorbing it.
They are. Traffic rose by 3.9%, but capacity, meaning the actual number of flights they added, only increased by 3%. That pushes their load factor up to 81.3.
Okay, for those of us who aren't airline analysts, what exactly does a load factor of 81.3 mean?
It simply means that, on average, 81.3% of the seats on every single American Airlines flight are physically occupied by a paying passenger.
Oh, wow, so the planes are packed?
Planes are fuller than they were, and the tickets for those seats are way more expensive. Corporate pricing power is currently acting as a massive buffer against these geopolitical shocks. So while the oil producers are trapped by their $60 hedges, the airlines are successfully sliding the cost of a $100 barrel of oil right onto the consumer's credit card.
That is wild. I mean, airlines can pass those physical costs down because, at the end of the day, people and businesses still need to fly. But when we look at the tech sector, companies can't just hike ticket prices to cover their problems.
No, it's a totally different game over there.
They are facing an entirely different kind of structural disruption, which is the artificial intelligence revolution.
The divide we are seeing in the technology sector right now is just staggering. We are watching an existential crisis and a historic gold rush happen simultaneously.
Okay, let's start with the existential crisis. Look at IBM. Their stock has fallen about 15% so far this year, and it dropped another 7% in extended trading following their recent earnings report.
Yeah, this is a bloodbath.
Because their software and consulting segment revenues severely underwhelmed. Investors are absolutely terrified that generative AI is going to fundamentally replace traditional consulting models.
The market is ruthlessly pricing in obsolescence right now. Think about what a traditional consulting firm actually does.
They send in a bunch of expensive people in suits.
Exactly. They deploy armies of highly paid analysts to spend months gathering data, writing code, and generating strategic business insights. If a generative AI model can now synthesize that same data, write that same code, and output a strategic roadmap in a matter of seconds for a fraction of the cost.
That legacy consulting model is incredibly vulnerable.
Extremely. And IBM is heavily reliant on that human capital intensive business.
But then you look at the other side of the coin, the company providing the hardware for those AI models. Broadcom just became only the 6th company in U.S. history to achieve a major historic market milestone.
Which is an unbelievable feat.
It is. Their stock was driven into record territory by Google's announcement of their new tensor processing units, or TPUs. Broadcom designs these custom chips. I was trying to think of how to visualize this divide. It's like the early days of national electrification, right?
Oh, that's a good analogy.
Broadcom is the company manufacturing the high-voltage copper wire and laying down the grid, making an absolute fortune. While IBM is basically running an old steam-powered factory, watching the electric lines go up outside, and panicking about whether they are about to become obsolete.
If we connect this to the bigger picture, we are witnessing one of the most rapid and violent reallocations of capital in market history.
Just pulling it from one side and dumping it into the other.
Exactly. Investors are pulling money out of anything that looks like legacy human capital and flooding it into the underlying infrastructure of the AI grid.
Right. But even the infrastructure builders have a limit. And this is the piece of news that really caught my eye in our source stack today. TSMC, Taiwan Semiconductor.
Oh, yeah, this was a huge headline.
They are arguably the most important chip manufacturer on the planet. They literally build the chips that power the modern world.
Well, they just drew a hard line in the sand.
They did.
They stated they have no current plans to adopt ASML's latest high numerical aperture extreme ultraviolet lithography machines, which I can barely say it, let alone understand it. What exactly is this machine, and why is TSMC refusing to buy it?
So, to put it simply, a lithography machine is basically an unimaginably precise printer.
Okay.
Instead of printing ink on paper, it uses extreme ultraviolet light to draw atomic-level wiring patterns onto silicon wafers.
Yeah.
That is how you make a microchip. As chips get more advanced for AI, the wiring needs to be smaller and closer together.
Right, more dense. Exactly. ASML's new high numerical aperture machine is the absolute bleeding edge of this technology. It can print smaller lines than literally anything else on Earth. The problem: they cost over $400 million each.
$400 million for a single machine. So if TSMC, the most important manufacturer in the world, is looking at that price tag and balking, does that mean there's a hard ceiling to this AI boom?
It is a massive reality check for the market. For the last 2 years, the prevailing narrative has been that the AI build-out is entirely price insensitive.
A blank check.
Exactly. The belief was that tech giants will pay literally whatever it takes to get the compute power they need to win the AI race. But TSMC's deputy co-chief operating officer publicly stating that this machine is simply too expensive, well, it shatters that illusion.
Because the math just doesn't work anymore.
Precisely. They still have to run a return on investment model. Even if a $400 million machine makes faster chips, can TSMC sell those chips for enough profit to pay off a $400 million printer? Right now, the answer is no. It proves that financial gravity still exists, even in the middle of a historic tech boom.
Wow. Well, tech and airlines, at least, are operating under logical constraints. You can map out the cost of a $400 million machine or the cost of jet fuel and see how it impacts the business.
But then I look at our sources for the retail space, and it feels like a sector completely disconnected from reality.
The consumer retail space is currently a fascinating study in rational fundamental shifts happening right alongside completely irrational trading mechanics.
Yeah, I'm talking specifically about Avis Budget, the rental car company. Through Tuesday, their stock ticker, CIR, had skyrocketed sevenfold in a single month.
Just absolute insanity. They were up 242% in April alone. They were on pace to absolutely smash the all-time monthly gain record set way back in April 2009. But then, suddenly on Wednesday, it suffered its worst day in 28 years with a massive, violent sell-off.
My first thought was, did rental cars suddenly become the most lucrative business on earth for 3 weeks and then crash?
Not at all. What you're seeing with Avis has absolutely nothing to do with the business of renting cars. You are watching the violent mechanics of a short squeeze.
Okay, break that down for me. How does a short squeeze actually create a 242% spike out of nowhere?
It starts with institutional investors placing massive bearish bets against Avis. This is called shorting the stock. To do this, an investor borrows shares of Avis from a broker and immediately sells them, hoping the price will drop.
Okay, so they sell high, hoping to buy low later.
Exactly. Their plan is to buy the shares back later at a much lower price, return them to the broker, and pocket the difference.
But what happens if the price goes up instead? That is where the trap snaps shut. If you buy a normal stock, your risk is capped at your investment. If it goes to zero, you lose what you put in. But if you short a stock and the price starts rising, your potential losses are theoretically infinite because there is no ceiling to how high a stock price can go.
Oh man, that's terrifying.
It is. So when Avis's stock started ticking upward, the brokers who lent out the shares demanded more cash collateral. This is a margin call. To stop the bleeding and close their positions, these short sellers were forced to buy Avis stock at the current market price.
So you have a massive group of panicked investors who are literally forced to buy the stock regardless of the price.
Exactly. And that panicked, forced buying drives the stock price even higher, which triggers margin calls for other short sellers, forcing them to buy, driving the price higher still.
It's just a vicious cycle.
It's a mechanical feedback loop that takes on a mind of its own. The crash on Wednesday wasn't a change in Avis's business model. It was simply the mathematical end of the squeeze, the moment when the forced buying finally exhausted itself and reality set back in.
Pure trading panic. But in that exact same consumer space, we have a story of real fundamental decline. Lululemon, the premium yoga wear giant, they have lost nearly 40% of their value over the last 12 months.
Yeah, their chart is ugly right now.
And in response, they just announced they're bringing in a Nike veteran, Heidi O'Neill, as their new CEO starting September 8th. But analysts are worried that Nike's own current struggles might mean this isn't the silver bullet they hope it is. So why is Lululemon crashing while the rest of the market seems to be flying?
Lululemon is suffering from a fundamental break in their pricing power. We talked earlier about American Airlines successfully passing costs to consumers.
Right.
Lululemon is finding out that consumers have a limit. With persistent inflation eating into household budgets, consumers are actively trading down. They are finding cheaper athleisure alternatives that look incredibly similar to Lululemon's premium products.
So they're just getting priced out.
Basically. When your entire brand identity is built on charging a massive premium and the consumer suddenly decides they can't afford that premium anymore, your margins collapse.
So a rental car company goes completely parabolic because of a mechanical trading glitch, and a premium retail giant loses nearly half its value because inflation is finally draking consumer habits. How is an investor supposed to separate real business health from just pure market noise?
This raises an important question about discipline. Avis is structural noise. Lululemon is a fundamental story. Bringing in a 30-year veteran from Nike is a massive pivot to try and fix real supply chain and brand positioning issues.
It's a real business move.
Exactly. But the market is unforgiving. If you get caught on the wrong side of a mechanical squeeze like Avis, or if you mistake a structural decline like Lululemon for just a temporary dip, you will be punished severely.
Which perfectly sets up our final source of the day, because it attempts to synthesize all this chaos. We have covered war in the Middle East, oil producers trapped by hedges, AI gutting legacy tech, $400 million hardware ceilings, and wild 28-year record short squeezes.
A lot of fear out there.
Right. Logically, you would think investors would be terrified right now, burying their cash in the backyard. But our last source, Milton Berg, argues the exact opposite.
And Milton Berg is not an analyst you easily dismiss. His historical track record demands attention.
Right, this is a Wall Street veteran with a nearly 50-year career. He advised legends like Stanley Druckenmiller and George Soros. He won Mutual Fund Manager of the Year in 1987, specifically for navigating the infamous Black Monday crash.
He knows how to read panic.
He does. More recently, he made a massive contrarian bull market call in January 2023, and he absolutely nailed the stock bottom in April 2025. And his message to the market today? A historic S&P 500 rally is just getting started.
He is incredibly definitive about it, too. In his interview with MarketWatch this week, he flatly stated, quote, "There's no reason at all to doubt this rally."
His models are predicting a median target of 8,499 for the S&P 500. That is roughly 19% above Wednesday's close.
That's a huge move.
It is. He tracks 30,000 individual indicators to build 2,000 action-based models. And what those indicators are telling him is that despite the scary headlines we just spent the last 15 minutes discussing, there is fundamentally no recession, the Federal Reserve isn't tightening the money supply, and inflation is, in his words, always good for markets where the Fed isn't fighting it.
Berg's entire philosophy is about ruthless objectivity. He believes in listening exclusively to what the market is actively doing with its capital, not what pundits are saying it should do.
Ignore the noise.
Totally. He calls opinions about the Middle East war or oil prices meaningless compared to the raw, undeniable data of market price action.
And the data points he highlights are fascinating. He points to a, quote, rare pattern that just triggered on the NASDAQ. From March 31st to April 10th, the NASDAQ 100 rose for 8 straight days after a decline of more than 12%.
That doesn't happen often.
No, he notes there were only 3 instances of this specific setup in the past, and they led to massive gains of 35%, 33%, and 9.5% before the next pullback.
That is what quantitative analysts call a momentum thrust. When you have total selling exhaustion, meaning everyone who wanted to panic sell has already sold and it meets massive institutional buying, it creates these historical explosive markers.
But there is one indicator he uses that I genuinely struggle to wrap my head around. He calls it the April 15 indicator.
This one is tricky, yeah.
So on April 15th, the S&P 500 hit a new all-time high. But on that exact same day, only 15 individual stocks in the entire index hit their own 52-week highs. Berg points out that a similar setup happened in February 1995, and the index went up another 40% without a pullback.
So what does this all mean?
Yeah.
Wait, if the overall index is hitting an all-time high, but only 15 out of 500 companies are actually at their own peaks, shouldn't that complete lack of broad participation be a massive red flag? How is 485 companies lagging behind a green light?
It's highly counterintuitive, which is why it's such a brilliant contrarian indicator. Most traditional analysts look at that narrow participation and say exactly what you just said. They say the rally is too thin, it's resting on a handful of tech giants, it's going to collapse.
That feels like the logical conclusion.
Right. But Berg looks at the exact same data and sees hidden strength. His logic is that the foundational momentum of those top companies is so robust, so undeniably strong, that even the dead weight of 485 lagging stocks was completely unable to drag the index down. Oh, wow. So they're just overpowering the drag.
Exactly. The market is grinding to new highs despite the drag. And he's backing up this macro theory with specific stock picks based on earnings streams. He's looking at companies like Woodward, TTM Technologies, Seagate, Celestica.
Lam Research, I think, was another one.
Yep, Lam Research, Fabrineth, along with longer holds like Interactive Brokers and Futu. He isn't trying to catch falling knives. He is buying stocks that are, in his words, already acting well.
It really is a masterclass in separating the emotional noise of the news cycle from the cold reality of price action. Okay, to quickly recap the absolute paradoxes we've covered in this deep dive, you have energy companies missing out on a $101 oil spike because they were mathematically trapped by their own surplus hedges.
A painful lesson in risk management.
Very. You have airlines thriving and hitting record revenues despite absorbing a $4 billion geopolitical fuel tax. You have the AI infrastructure boom finally hitting a financial ceiling, with TSMC refusing to buy $400 million lithography printers. And through all of that global chaos, you have data-driven indicators from a Wall Street legend screaming that a 19% bull market rally is imminent.
It is the ultimate reminder that the market is a complex, deeply adaptive system. It rarely behaves the way common sense dictates. But I want to leave you with one final, unmentioned thread to ponder as you digest all of this information today.
Let's hear it.
We saw massive corporations hitting their absolute financial limits today. TSMC refusing those $400 million machines, oil producers locked into $60 contracts, airlines bracing for $4 jet fuel. But if the entire market rally and the corporate revenue growth we've discussed today is currently resting on the consumer like American Airlines passengers happily absorbing all of these massive price hikes, what happens on the day the everyday consumer finally draws their own line in the sand, just like TSMC did, and says, no more?
That is the multi-trillion-dollar question, and one we will certainly be watching closely. Thank you for joining us for this deep dive. Make sure you keep your eyes on the NovaStream 24/7 stream right here on YouTube. Watch those live crypto charts, track the global indices, and keep reading the auto-curated breaking news feed to watch these incredible stories unfold in real time.